Everyone says that QQQ crushes all the dividend ETFs. But this year, this boring ETF has flipped the script and has been winning in the return percentage category. Imagine a dividend ETF that's returning a higher percentage than QQQ on the year, and it pays you a 3% plus dividend yield. And the dividend growth is almost 10% year over year. And by the end of this video, you'll learn the true income side of the story, the major risk that no YouTubers put in their thumbnails, and you'll know whether this ETF or QQQ is a better fit for your portfolio. And the answer is probably what most YouTube channels won't tell you. So stick around to the end and you'll see just how close these two ETFs really are to each other, or maybe they're just that far apart. But before we get started, welcome back to the channel where we discuss how to grow our portfolios for the ultimate portfolio payday. Just remember, I'm some random dude on the internet, so always make sure to do your own due diligence before you invest any of your hard-earned money in the markets. What we discuss here definitely works for my portfolio, but it might not work for yours. So let's get started. So in case you haven't guessed it already, I'm talking about the ETF SCHD, which is the Schwab Dividend ETF. First, let's start with the number that's breaking most people's assumptions. SCHD on the year has returned 18% so far, while QQQ is roughly 16%. If you're familiar with SCHD and know how painstakingly slow it's been over the past couple of years, that 18% return on the year so far is not supposed to happen. QQQ is what Miami is in 2026. It's wild, it's fast, it's volatile. SCHD is what Miami was in the 60s. Slow, old, boring, just no excitement whatsoever. You basically just buy the ETF and set it and forget it, collecting your dividends over time. So why is this dividend fund winning right now? First, we have favorable sector rotation. SCHD benefits from a heavy weighting in strong performance sectors like healthcare, consumer staples, and financials. Next, we have strategic tech adjustments. The fund increased its technology allocation to include dividend-paying foundational tech such as Qualcomm and Texas Instruments, participating in the market's upside while avoiding highly speculative megacaps. We have strong fundamentals. The underlying index selects companies based on free cash flow, solid balance sheets, and historical dividend growth, which insulates the ETF during periods of market volatility. Lastly, we have attractive valuation, which is trading at a discount relative to the broader S&P 500. The fund has experienced a bullish breakout as investors rotate toward more reasonably priced, value-oriented assets. Now, if you stopped the video right here and walked away, you'd probably think that SCHD is a better fund. But the story is a lot more complicated than that. If you zoom out 10 years, this story gets flipped upside down. QQQ is compounded at an annual average rate of 20.5%. SCHD has done roughly 13%. If you had put $10,000 into each fund 10 years ago, QQQ you'd have somewhere around $71,000 today. In SCHD, you'd have roughly half of that, around $36,000. So which number do you actually look at to determine if you're going to invest in it or not? Do you consider the 1-year story or the 10-year story? The honest answer, both are true. And neither one tells you which fund is right for you in your portfolio. That really depends on something that we haven't discussed yet, risk. Here's what nobody really discussed is when comparing QQQ and SCHD. Its max drawdown since inception is negative 83% versus SCHD's minus 33%. Translate that into dollars. That same $10,000 for QQQ at its worst point would be worth roughly $1,700. In SCHD at its worst point, you'd probably still have around $6,700. And this data is in ancient history. In 2022, QQQ dropped 33% for the year. So if you needed that money during the meltdown, that 20.5% year over year average annual return wouldn't have mattered. The volatility of QQQ moves the same in both directions. You can have massive swings both up and down. So depending on your outlook for which ETF is more important to you, SCHD has been slow and steady. QQQ has had massive growth, but also massive pullbacks. Now let's talk about the income component, the dividends. SCHD has roughly a 3.2% dividend yield, while QQQ is roughly 0.4%. If you had $100,000 in each, SCHD would be bringing in roughly $3,200 a year, and QQQ would be bringing in roughly $400 a year. If you need your portfolio to pay you one day, that dividend income gap may matter more than the 10-year CAGR. Another thing is the difference in cost with the expense. QQQ has a 0.18% expense and SCHD has a 0.06% expense. Relatively small difference, but if you compound that over years and decades, it definitely is going to add up. So which one should you actually buy? In all reality, this video was never about picking QQQ over SCHD or SCHD over QQQ. Realistically, what matters between the two is growth versus income, and how much pain in the volatility can you stomach or can you handle. If you're decades away from retirement and can stomach a 30 to 80% drawdown in some years, QQQ has paid handsomely for that risk. If you want steadier compounding income along the way, with a 10% average annual dividend growth, SCHD is the one. The thing is, a lot of investors don't just pick one or the other. They pick both, and they let the mixture of the two handle their risk management for them. That's definitely a personal decision based on your timeline. And as for myself, I currently own both in my portfolios. I like to balance the volatile growth with the slow, steady income. That will pay me for decades to come, all while growing the dividend year over year. So definitely the decision is up to you. If you want to check out an ETF that has grown 173% over the last 5 years, check out this video right here. And drop me a comment down below. Do you currently own QQQ? Or do you currently own SCHD? Or do you own both? Thanks for watching. I'll see you in the next video.